What does Norway know that the markets don't? Well, let's ask Bill Hubard, chief economist at MIG Bank. Bill, I guess it is very interesting that Norway's doing this. Are you as confident as the Norwegian government?
Yes, I am. I guess I'm like Warren Buffett, fear and greed. And I mean, let's go back to a year ago, February, when Nouriel Roubini said, I think on Bloomberg, that the world was over. It was just going to end tomorrow. Well, thank goodness, because I bought a few Barclays bonds at 21%, some Lloyds Bank bonds at 22%. Not only have I got the yield, but the price appreciation, and I think it's the right decision, okay? We saw this before when it all went horribly wrong in May. A lot of that was, again, maybe down to the euro. Everybody was 118 heading towards parity. I think it's a very smart move. Would I put all of my money in? You never do, but I'm a member of the 50% club. They're not going to default. I mean, I haven't read the Maastricht Treaty enough times, but it's a situation where there's value, okay? And what you do is you start nibbling away at it. And when somebody says, well, maybe Norway's doing it, then maybe CalPERS starts to do it, just a small amount. I would not do it myself, for the simple fact is I don't like the euro, so I would be concerned about the currency, but they don't have the currency risk.
No, they're also looking at other countries, the so-called pigs, you know.
Yes.
Ireland, Spain. Ireland particularly is in the spotlight at the moment, particularly with what's been happening with Anglo-Irish Bank, and a real concern that investors are not happy with what's going on there. That's a shame, because really Ireland was the kind of poster boy of austerity measures for a while.
I mean, we've discussed this. Remember when Ireland was the first person saying, well, we're going to do something about it. We're going to, we heard that new word, austerity. We are really going to work on it. Unfortunately, I think Ireland is probably, as you say, is not the poster boy right now. But all of a sudden, if we start seeing a big downward move in Greek bonds and Portuguese bonds and Spanish bonds, then maybe everybody says, well, maybe we better start looking at Ireland. They will start looking attractive. And I think that's what will happen. They will be positively affected by what we call the domino effect.
And so overall, looking at Europe, you say that you're not very keen on the euro at the moment.
No.
It's not looking bad, though, is it? I mean, as you say, still that chat about parity, it didn't go anywhere close.
No, not at all.
Did it?
I guess my biggest problem was I wasn't looking at parity, but I thought 115, 118 is the correct level. I guess I probably maybe missed the boat, although, and I said it a number of times here, I am a double dipper in reference to the U.S. housing market. I'm not a double dipper in reference to the economy. I am concerned about the dollar coming up to the midterm elections, because unfortunately, Barack Obama was dealt a very difficult hand. I think he's done an excellent job, but again, it's a very difficult hand. So I see the dollar pressure continue to go on. But I mean, we've seen this move into gold, a move into the Swiss franc, a move into the Japanese yen.
So really what you're saying is that the euro is doing well only because the US dollar is doing badly.
Through default. And I mean, I didn't trust sterling at 160. I think 155 heading towards 150. But as you just said, it's doing better for the wrong reasons. And one of the things when we start getting a little bit more stability, and we saw a very interesting move on Friday's non-farm payrolls, when all of a sudden we went from double dip to, oh my goodness, the Fed may start raising rates September of next year. We saw a 17 basis backup in the space of an hour and a half on the Treasury 10-year, and everybody felt justified that, gee, U.S. rates will be 3% in the 10-year by the end of the year. And all of a sudden, the stock market was going to do better. Well, we kind of had a bad day when it opened on Tuesday. You know, I'm still a deflationist. I'm still a bond man, and I think it has value. If the euro was my currency, yes. As an individual and advising clients, I would say, start nibbling away at it, because there's an excellent chance, and we're talking about the Bank of England and QE2. Well, austerity, I think, is one of these words that should not be used in 2010, 2011, maybe 2012, because if we'd had austerity after that slight problem with Lehman, we would be in depression part 2, 3, 4, or 5. The central banks are the buyers, okay? And as we saw with the Beige Book yesterday, a few of the districts are not as strong as they should. We're not going to have a double dip, but it's a situation. I am a bond man. The bond market is telling me real value.
Bill, thank you very much indeed for that, as ever. Thank you.